Welcome back. So stocks posted huge gains over the past year, but is all the liquidity in the market actually killing returns for investors?
That's what Citi Private Bank is suggesting, at least. I mean, serving high net worth individuals, Citi Private Bank is recommending that their clients move into illiquid assets like real estate or private equity funds.
Maybe some of theirs.
Things you can't cash in too early. And yes, they probably sell you some of those things as well. Joining us with their thoughts, Martiak, Senior Wealth Strategist at Premier Financial Advisors. And also with us is Kelly Campbell, the CEO of Kelly Wealth Management. What do you, I mean, the point is, individual investors are encouraged to go with liquid assets because they're able to get out when they want to get out of those assets. But the Citi point is that by doing that, you're limiting the returns that you can get by going only with those liquid assets. What do you think?
They make a very good point. Investors should have uncorrelated assets in their portfolio, in a well-diversified portfolio. So when they don't, that limits some of their risk-adjusted rate of return over time. And I read their research, and I agree. And I counsel my clients on having anywhere from 10 to 30% of their portfolios, especially the accredited investors, the high net worth and the ultra high net worth investors, to have that much of an allocation in these non-correlated assets, alternatives, real estate, private equity hedge funds.
But Kelly, here's what I want to know. What's the best way for the retail group to get exposure to some of these asset classes? Because we're talking about sophisticated products sometimes that don't really make sense on an individual level.
Well, you know, the problem that you have is that they are now institutional investments that weren't even available to these retail clients years ago, and maybe even 1 year ago. Now they're available, so they need to typically get them through someone that knows how to work with them. They're complicated, they're different, they're not your everyday stock and bonds, so they need to start looking to some of the, the better financial advisors, the ones that work with people that are in a high net worth space, that are going to be able to guide them to the right investment, and also make sure that that investment follows their portfolio. Because what I've seen is that a lot of people want them because now they can, these hedge fund companies can now market to these clients directly, but the bottom line is they're not getting the information they need to make good decisions.
But
so they need to work through someone.
Kelly, that goes against something I learned a long time ago, a very basic premise when you're going to invest in what you know, understand what you're getting yourself into, and let's face it, as you said, some of these investments are pretty complicated.
But nowadays, if you think about even the stock market in general, with its globalization, it's so complicated that you need to have someone that you're going to work with that will help you understand it and bring it down to layman's terms, because yes, they are complicated. But again, I mean, look at some of these, even a mutual fund nowadays that can, a lot of funds can go long and short, but the fact that you can get a short position in a mutual fund is complicated, but it's available to the retail investor.
Mark,
so
it seems to me,
different.
though, the story here is also one where, yes, you've had a great year for the market, but it hasn't been a great year for a lot of people, for example, on the sell side. Why? Because there hasn't been a lot of churn. Because look at the fee ratio on most equities, it's extremely, extremely low. So they rely on that churn, in other words. Is this really just about trying to get more people to buy more products that have a little bit better margin?
I believe it is. I do believe it is. In that research that Citi released, I understood that their private clients, on average, had about 30% sitting in cash.
Wow.
That's a lot of cash to have on the sidelines when you talk about, again, a negative inflation-adjusted rate of return. If inflation's running between 2 and 3%, you're sitting in cash, you're making very, very little. It's not worth staying in cash. So it's a nudge for clients to move into alternatives as this particular market becomes appreciably higher in terms of valuation.
I mean, one thing in favor of going with these illiquid assets is it does force this discipline to stay with them for a longer period of time, a 5-year period or whatever. A lot of investors will claim that they are a long-term investor until the market goes down 5–10%, and suddenly there is a 24-hour time cycle they're on, right?
You make a very good point, Bill. That hurts investors' long-range investment strategy planning and their financial goals when they pull out. And let's not forget the proliferation of ETFs and what that's done to be able to get the Main Street investors and institutional investors in and out of these products very quickly. That also has an effect.
And interestingly enough, Kelly, a lot of these new ETF products come with a lower fee ratio, for example, and some of the the trickier structured and alternative investments.
You know, and not only are they, you know, yes, they're a little trickier, but the bottom line, they're easy in, easy out. And the whole problem with that is that, you know, people want to know what, you know, they can pull the trigger. Oh, hey, I remember when the stock market crashed. No, wait, I want to be able to get out before that happens. People rarely make the right decisions. They make emotional decisions. The good thing about
blame them?
Well, but again, if they're going to trust some of these managers, which some of them are phenomenal, but you know they need to think about this. There's a discipline to the investing process, and they need to have that discipline. Most investors don't have it. They've performed the worst out of the whole investor class. The average investor has performed the worst out of everyone.
Well, how many people bought commodities instethat of dumping them last year?
Yeah, exactly. Yeah, what's going to go up now? Tell me now what's going to go, right? That's all they think about. Gentlemen,
we'll talk about that tomorrow. Thank you.
We'll check back with you later this year.
Exactly.
See you later.
Thank you, Bill. Thank you, Kelly.